stop scrolling. While most investors were panicking about market volatility this summer, smart money quietly moved $38 billion into one asset class. And if you're watching this in August 2025, you have roughly 6 weeks to position yourself before the Fed's September meeting changes everything. This isn't just another investment video. This is about a window that's about to slam shut. I know that sounds dramatic, but here's the thing. I've been tracking institutional money flows for the past 6 months, and what I'm seeing is absolutely wild. Everyone's talking recession, everyone's talking market crash, but the data is telling a completely different story. The smart money isn't running away. They're positioning for something massive. In the next 10 minutes, I'm going to break down exactly 3 specific ETFs with their exact tickers. Why August 2025 is the most critical positioning month we've seen in years, and the simple strategy you can implement today that could set you up before everyone else catches on. Plus, I'll show you the one piece of data that proves why September is going to be a game changer for your portfolio. The Fed's dilemma. Here's what's happening right now that most people are completely missing. We've got this incredible market paradox playing out in real time. GDP just rebounded to 2.97% in Q2. That's solid growth, not recession territory. Consumer sentiment hit a 5-month high at 61.8. But here's the kicker. Investor sentiment is sitting at just 36.78%, which is actually below the long-term average of 37.62%. Think about that for a second. The economy is showing strength, consumers are feeling better, but investors are still scared. That's not a red flag. That's a massive opportunity. When there's this kind of disconnect, smart money steps in to fill the gap. And here's the catalyst that's going to change everything: the Federal Reserve. Right now, we're sitting at a Fed funds rate of 4.25% to 4.5%. And every single piece of data is pointing to rate cuts in September. Not maybe, not probably, it's happening. When the Fed cuts rates, money becomes cheaper, risk assets rally, and the investors who positioned early get rewarded. But here's why August is so critical. We're in what I call the quiet before the storm phase. The Fed meeting is September 17th, which means you have about 6 weeks to position yourself before institutional money really starts flooding in. Once that September meeting happens and rates start coming down, the positioning opportunity is over. The 3-asset strategy. This brings me to the 3 ETFs that are perfectly positioned for this moment. And I'm not talking about some obscure investments. I'm talking about strategic plays that address exactly what's happening in August 2025. ETF number 1 is SPY, the SPDRS and P500 ETF Trust. Now I know what you're thinking. SPY isn't sexy. Everyone talks about SPY, but here's what everyone's missing. SPY is sitting at $634.46 right now. It's up 8.90% year to date, but look at the composition. Nvidia is the top holding at 7.92% weighting, Microsoft at 7.05%, Apple at 5.84%. This isn't your grandfather's S&P 500. This is an AI revolution portfolio disguised as a boring index fund. The technology sector makes up 35% of this ETF, and we're still in the early innings of the AI transformation. When the Fed cuts rates in September, growth stocks historically outperform, and SPY gives you diversified exposure to the companies that are actually driving the economy forward. Plus, with an expense ratio of just 0.09%, you're getting this exposure at virtually no cost. The smart money isn't chasing individual AI stocks anymore. They're getting broad exposure through SPY and letting the index weighting do the work. ETF number 2 is where things get really interesting. DFNG, the VanEck Defense ETF. This is the play that 99% of investors have never heard of, but it's up between 44% and 60% year to date, depending on which exchange you're tracking. 1-year returns, we're looking at 70% to 80%. These aren't typos, these are the real numbers. Here's the story Wall Street doesn't want you to know. While politicians talk about peace, defense contractors are printing money. NATO countries are all targeting that 2% of GDP spending on defense. Geopolitical tensions in Europe and Asia aren't going away. They're accelerating military modernization and cybersecurity spending. The top holding in DFNG is Palantir at 8.67%, followed by RTX Corporation at 8.24%. These are companies with multi-year government contracts that are essentially recession-proof. But here's the really smart part about this play. Defense stocks don't just benefit from conflict, they benefit from the threat of conflict. As long as global tensions remain high, defense budgets keep growing. And unlike tech stocks that can be volatile, defense companies have predictable revenue streams from government contracts. It's like getting growth stock returns with utility stock stability. The third ETF is IAU, the iShares Gold Trust, and this is where that $38 billion story comes full circle. Gold ETFs have seen $38 billion in inflows just in the first half of 2025. That's the largest inflow since 2020, and we're not even through the year yet. IAU is sitting at $61.62 right now, up over 25% year to date, with one-year returns over 40%. But here's the real catalyst. JP Morgan just raised their gold price target to $4,000 per ounce by Q2 2026, with a near-term target of $3,675 by Q4 2025. When JP Morgan moves their price targets by that much, they're not guessing. They're positioning. Central banks are forecasted to buy 900 tons of gold in 2025 as they diversify away from dollar holdings. When the Fed cuts rates in September, real yields fall, and gold, which doesn't pay interest, becomes relatively more attractive. It's not just a hedge against inflation anymore, it's a strategic asset that major institutions are accumulating for portfolio diversification. And here's what most people don't understand about IAU specifically. It has an expense ratio of 0.25%, which is higher than some competitors, but it's backed by physical gold stored in secure vaults. You're not buying a derivative or a promise, you're buying actual exposure to physical gold bullion. In uncertain times, that backing matters. The Portfolio Blueprint. Now here's how these three work together, and this is where the strategy gets really powerful. You're not just buying 3 random ETFs, you're building a portfolio that's positioned for 3 different scenarios. If the Fed cuts rates and we get that growth rally everyone's expecting, SPY gives you broad market exposure with heavy tech weighting. You're positioned for the AI revolution and the rate cut rally at the same time. If geopolitical tensions escalate or we see increased defense spending, DFNG gives you exposure to the one sector that actually benefits from global uncertainty. While other sectors get hammered by conflict, defense stocks thrive. If we get economic volatility, inflation concerns, or currency debasement, IAU provides that portfolio insurance that's already proven its worth with those massive institutional inflows. The beauty is that these 3 don't just work in isolation, they're complementary. When growth assets like SPY get volatile, gold like IAU often rallies. When global tensions support defense stocks like DFNG, they also support safe haven assets like gold. You're not betting on one outcome. You're positioned for multiple scenarios. For allocation, this obviously depends on your risk tolerance and investment timeline. But here's how I'm thinking about August 2025. If you're building a core position, SPY should be your foundation, maybe 60% of your ETF allocation. It gives you that broad market exposure with built-in tech growth. DFNG could be 25% for that growth kicker and geopolitical protection. The defense sector is having a moment, and the fundamental support continued outperformance. IAU rounds out the final 15% as your portfolio insurance. It's not just about downside protection. Gold is in an active uptrend with institutional support. But here's the timeline that matters. The Fed meets September 17th. By then, positioning needs to be complete. August is your accumulation window. Once that rate cut happens, the easy money gets made, and you'll be buying at higher prices with everyone else. So here's where we stand. 3 ETFs, 6 weeks, 1 opportunity. SPY at $634 for broad market exposure to the AI revolution and rate cut rally. DFNG for defense sector growth that's already up 44% to 60% this year with more room to run. And IAU for gold exposure backed by $38 billion in institutional inflows and JP Morgan price targets near $4,000. The window is August 2025. The catalyst is September 17th. The opportunity is positioning before everyone else figures this out. But here's what I need from you. Drop a comment below with your biggest investment concern for August 2025. Are you worried about timing the market? Concerned about portfolio allocation? Unsure about risk management? I read every single comment, and your questions help me create better content for everyone. And if this analysis helped you see August 2025 differently, hit that like and subscribe button and ring the notification bell. The market rewards those who position early and think differently. August 2025 is your positioning month. Don't let it pass you by. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.